Good afternoon. Thank you for joining us today. I'm Lisa Schneider, Managing Director for Russell Investments Healthcare Practice, and I'm joined today by Al Salvato. Al is the Senior Vice President of Finance and Chief Investment Officer of Jefferson Health. Al is responsible for Jefferson's $11 billion investment program, which combines a mix of short, intermediate, and long-term balance sheet assets, as well as their pension programs. Al is active in the community, serving on a number of advisory boards as well as community boards, and Al holds a degree from Villanova University. So we're going to kick this off shortly. We do want this to be an active and open dialogue, so if you do have any questions, please just click on the Q&A button on the bottom of the Zoom screen. We'll see those and be able to address all of your questions. So I'm going to kick this off. Al, many health systems, nonprofit health systems, traditionally have managed their balance sheet assets by having a pool of very short-term operational cash as well as long-term pool. Mm-hmm. And over the last sort of couple of years, particularly coming out of the pandemic, many of the organizations we are talking to are starting to ask questions about the merits of further segregating that to include maybe an extended long-term pool or an intermediate term pool. And I know that's something that you've implemented at Jefferson. So we'd like to kick this off by just, tell us a little bit about Jefferson and what sort of challenges were you looking to solve with this structure?
Yeah, Jefferson, the genesis of what we're going to talk about today started back in probably about 2016. Jefferson, for those who don't know, is a Philadelphia-based academic health center. We've got currently today 18 hospitals in the system, an academic division, as well as an insurance company underneath the program. And that profile that I'm outlining there did not exist in 2014. We've had significant rapid growth through primarily mergers and acquisitions over that period of time, resulting in a very different balance sheet than what we had originally. And what you were highlighting earlier, relative to how we used to manage money, we used to have a working capital pool and a long-term pool. But as the balance sheet of the organization changed, it created a need to kind of take a look at a very different profile of the organization. As institutions were coming into the mix, they brought with them different debt profiles, different investment portfolios, and a different risk profile just in general. And so I was thinking about how we could better structure the investment portfolios to be responsive to risks that were present on the balance sheet. And we kind of stumbled upon efforts that were going along the line with Kaufman Hall, who serves as a consultant with us in other aspects of the organization. But they also had a methodology for allocating assets as compared to the risk profile on the balance sheet. So in 2017, we engaged with Kaufman Hall to take a look at our balance sheet and our investment portfolio and figure out a methodology by which we could better manage against the risks that were present on the balance sheet. So we undertook a significant effort in 2017 that involved really participation from a very broad segment of the population, including rev cycle people, including leadership, including finance individuals, to kind of look at the balance sheet, identify risks that were present on the balance sheet, and then how to take those risks and be responsive from an investment standpoint. So this effort again started in 2017, and we've been executing upon that profile all along.
Mm-hmm. And I know you have some exhibits with us. Can you talk to us a little bit about maybe in detail, how did you think through organizing all of those risks, and what does that end up looking like as you start to put it together?
So what I'll do, I'll up against a slide here, and I don't know if the individuals can see the slide, but we basically took a look at, again, the balance sheet and the risk profiles, and we kind of categorized some of these risk profiles in series of buckets. One would have been working capital reserves, which again is monies that you believe you're going to need to have short-term payments against accounts payable. Some of the other risks in the core operations and strategy buckets reference revenue cycle activities, clinical quality, operations, technology and data issues, and then strategy and disruption. The next bucket would have been the capital spending requirements over a protracted period of time, say 5 years, and what that would potentially demand upon the cash profile. And then the last one was the comprehensive debt profiles to kind of make sure that we were satisfying debt service requirements, as well as our compliance tests on debt, as well as just potential for additional debt down the line. And when we looked at that whole horizon, we identified that we probably had about $3.7 billion worth of contingent risk on the balance sheet that we needed to address in some manner. And the analysis work that we did with Kaufman Hall back in 2017 and what we continue to do now is kind of continue to look at digesting information as we develop our operating budgets or capital budgets and see how that may impact our investment profile. You look at these risk buckets in different ways. Again, working capital bucket, again, is really how much money do you need to have on hand to be able to satisfy accounts payable draws or pension draws, et cetera. The core operating strategy bucket is basically one that you look at with a 2 to 3 year kind of horizon. What do you think you're going to be doing, spending money on over the next 2-3 years? So planned expenditures that you already know about that are in the queue that you want to have cash funds available for those programs. The capital is more of an extended perspective, and you can have a broader perspective on that one because there are capital plans that are in place, but you may not choose to execute on them, considering what your operating performance may be. You may say, we're going to defer a program or we're going to cancel a program. And so that has a different window of opportunity that you can lay off some of that risk. It doesn't become a dedicated offset. It becomes more of a contingent kind of offset down the line. And the last buckets is really on the debt side, where you have to satisfy your debt service payments, future debt transactions that you may be thinking about, or concerns about puts that you may be facing on some of those debt transactions. So you're able to bucket things and have what we call risk responses associated with each one of those buckets. Working capital, you have to be 100% funded at all times. The core operations component, that are things that you know about coming, you have to have liquidity available for that. The other buckets, you can start saying, okay, we've got contingent liabilities there that we may not choose to satisfy, so we don't have to reserve as much, and therefore we can invest those in a longer term perspective. That's what that risk response is the ability to respond to those kind of risk profiles. Post that, then you can start figuring out how you're going to lay out assets within a series of portfolios to kind of satisfy the returns on the demands for those particular cash, but also generate some return profiles that are linked to that liability profile. So that's kind of how we've structured the map, so to speak.
Right. And I know you called this, I think, originally an integrated risk financial framework. Have you adopted that thinking, and how does it really allow you to think about how are you aligning with what you're doing with all of your resources in supporting the broader needs of the organization?
It's an effort that we refresh every year. So every year, depending on what's going on with the organizations, if there was nothing fundamentally changing in a significant way to the balance sheet profile, then we weren't making any changes as far as the asset allocations in the investment accounts. But if there were changes, like we brought on another institution that had a fair amount of debt associated with it, had an open pension plan, things like that changed the dynamics. The other component was we bought an insurance company. That changed the dynamics of the profile, and that forced us to do a deeper dive and do a more significant refresh to the liability profile as well as the investment accounts.
Now, when you say deeper dive, so Jefferson, like many health systems, it is a very broad and complex organization. How far into the organization, the scope of the types of people within the system do you have to go to get the information that you need to accurate? Because I think a lot of this depends on accurately evaluating risks that you have so you can catalog them.
So the first go through was a very deep dive into the organization. It was a lot of interviews from a lot of different segments, whether it be the university components, getting a clear understanding of what their wants and needs were going to be in the future, whether it was the clinical pillar, which was the primarily going to all the presidents of the organizations and speaking to them and understanding it, going to the rev cycle folks, going to strategy folks and understanding what their demands for capital might be going out into the future. Luckily, Jefferson always had a very detailed 5-year forecast. So we were always being informed annually. We'd be refreshing that 5-year forecast. We were always being informed of things kind of in advance, but it made sense to go out and actually interview folks. So ourselves and the Kaufman Hall folks actually went through that pretty extensive process. As the years rolled on, that 5-year forecast that we're doing kind of pulls a lot of that information out. But as we were integrating other institutions into the mix, we then had to go out and speak to those individuals, those same kind of individuals, finding out what their wants and needs may be or what their concerns may be. The last refresh that we did, we went from basically 2017 to 2021 doing that refresh kind of on our own because there wasn't anything fundamentally big changing. But in 2022, it demanded that we do a more significant refresh. We brought Kaufman Hall back in to kind of help us go through that entire process again and realigned again the asset allocation profiles and probably more, and we'll get into it about the asset buckets, but probably more on the long-term pool where we were actually able to extend more illiquidity into that portfolio than we had before. So it's a iterative process, but it is one that requires a lot of information coming back to us. So the investment office digests that, and we also then incorporate our investment consultants to help us structure the accounts and the allocations to satisfy the risk and risk profile and return profiles that we're shooting for.
Right. So why don't we take the audience through that step then? So you've got the risk profile catalog. Then what's your next step as you start to move through figuring out what does this mean for how you actually allocate the resources and think through investment structure? So
once we determined what this risk profile would ultimately be, one of the other components that we had to incorporate in was associated with a debt profile and really the health of the organization from a ratings perspective. So we established cash flow targets, which were linked primarily to us maintaining our credit ratings. We don't really have a days cash on hand covenant test. We have a little one relative to bank debt, but days cash on hand isn't really a covenant requirement, but we established bands in which we wanted to live with. So our normal cash position, days cash on hand position would be about 200 days cash on hand, but we set a floor that we did not want to pierce below about 175 days. And that was driven principally by medians that the rating agencies have for our rating category. So that was one of the tiers that we set. We then also looked at from a investment portfolio, how much volatility could we withstand within the portfolio, because days cash on hand isn't just working capital, it's your unrestricted assets in your pool. And so how much volatility could we withstand within that portfolio to maintain that days cash on hand target? So we kind of looked at, black swan kind of events that would then require you to potentially liquidate assets out of the longer term assets to build up liquidity, et cetera. And we established a loss limit in this particular case of about 14% from a AUM standpoint. And then also established a max volatility target for the overall investment program at 9.6%. So those bands basically keep us in line with maintaining that liquidity profile that we have to have for the overall investment account. So that's the second tier of the measurement process.
And how frequently do you look at, updated capital market expectations and stress test how your portfolio might do in the coming economic to know that you're going to
That's part of that yearly refresh.
Part of doing that every year.
Yeah. And part of the investment committee report too is measuring against these
Mhm.
targets. So we actually have a dashboard that we report out the allocations, the volatility on each one of the pools of assets, and also the days cash on hand position of the organization. So we're reporting that out every quarter. So we're always kind of keeping those things in the back of our minds as we're allocating assets to the different strategies that we have.
From a governance perspective, do you feel like that's been helpful to the board and the committee and
Yeah,
everybody understand
I should have touched on that.
and support?
Yeah, when again, the growth factor that we had, and you talked about asset base going from, $2 billion up to near $11 billion. We inherited a lot of assets. We also inherited 6 different investment committees. And so I was struggling with each one of these investment committees because they all had different risk profiles associated with them. Some were very, we won a lot of cash. Some were all invested in money market instruments. Some were invested in mutual funds. Some had some, investment programs, but they were varied and very expensive. But each one of those committees felt very invested in that strategy that they had. And so I had to think about ways to be able to try to figure out how to get them comfortable with a rational approach. This was the rational approach that I was able to get them all on board with, and that allowed me to liquidate all those funds and put them into a general university investment program that is unitized, so that they each, if they're endowment assets that they each have their say on those buckets, but the unrestricted assets became university assets. So that was a big education process, and we ultimately created a single investment committee that is no longer made up of individuals who were legacy trustees. It is purely a committee that is investment professionals at this point in time, which creates a very different dynamic as well. But this program here allowed them to kind of sink their teeth into the story that we weren't going to be putting organizational assets at risk and risky assets. And therefore they got a lot more security out of it. They also realized that the benefits of commingling assets and the savings that was able to be generated as a result of, much lower investment management fees, lower consulting fees, except, one set of actuaries, on and on and on. So we inherited 15 different portfolios. 10 of them were what we would call the unrestricted asset base, restricted as far as endowments go, but unrestricted from that bucket. We call that the non-qualified assets. And we inherited 6 DB plans, which are all commingled from an investment standpoint now. Those were all changed as well. So very different base in a relatively short period of time.
Yeah, and so this structure and process is really what was ultimately set up for originally, was to streamline a lot of post M&A complexity.
Correct.
And deal with that. And I would imagine significant cost savings in doing so.
Yeah, significant cost savings in the probably the tens of millions of dollars. In fact, when we first consolidated the assets, if I measured the fees that were being paid by all the institutions and just married them up to what our current fee structure is, of the $13 million a year delta in fees alone.
That's quite significant.
Yeah. So and even to this day, we're reaping significant benefits from the investment program that we have that we can talk about later. But that is still resulting in, for us, about a $6 to $8 million fee break.
That's significant. Now, it's interesting. I know you set this up really to help with the complexity, but at what point did you sort of have that aha related to liquidity? And I think draw on cash. I think you probably see from having both the finance and the investment arm. And, many CIOs may not on a day-to-day basis have the acknowledgement of the draw that the organization might take on their investment pool and how that's changed, particularly
So-
after the pandemic.
So I have a lot of gray hair on the top of my head. So I've been around a while. So I think I had the aha moment in 2008,
Mhm.
in all honesty, when assets were just being crushed. Debt portfolio was getting crushed. We had a lot of variable rate debt in there where things were going to be potentially put on me. And
Mhm.
so I had moments of panic during that period of time that stuck with me. And as we migrated forward to the point where we started thinking about this, it was always in the back of my mind that I needed to create structures that dynamically linked the liability profile of the organization to the investment pool.
Mhm.
So it started there. It's just been reinforced even more so in this period where the operating lines of many of my peer organizations are just getting hammered because of the inflationary pressures. No less COVID, but more so right now, inflation pressures. And the stories that I'm hearing from other institutions who've got long-term pools and working capital buckets, and how they're having to evade into their long-term pools to be able to fund some of the calls on cash that they're having now. So it's just been reinforced, but it's since 2008, I was always thinking about it. This gave me an opportunity to kind of do something in 2007, gave me an excuse to do something. And therefore, I'm happy we're positioned the way we're positioned now versus where we may have been if we hadn't done this.
Yeah, we certainly don't need to go back to 2008 again, but it's interesting, I think, for health systems, particularly last year, while it wasn't the same 2008 drop on the investment portfolio, it did come at the same time where you had shrinking or negative operating margins due to the inflationary pressures, and then an episode of, an environment of rising interest rates where now you may not be able to finance the organization with increased debt financing.
Yep.
So that sort of perfect storm. Do you feel like this structure has helped manage that environment somewhat, or at least understand how to balance and appropriately allocate your resources?
Yeah, but it has. There's no doubt about it, and it reaches beyond just the investment office now too. It's actually part of finance. It's part of budgeting. It's part of forecasting, and it's informed. It goes both ways, and so it has allowed the organization to kind of focus a little bit more on credit structures. We've took advantage of the market conditions and basically refinanced all the debt. So we're sitting at about 86% fixed rate debt now. So it allowed us to use the same kind of theories into other areas where we're trying to mitigate risk.
Right.
We're taking down the liability profile in the pension accounts. We've annuitized pension assets. We've built up the LDI portfolio in this current environment. So it always brings my brain back to how can I mitigate risk in the balance sheet. So it's a broader program than just worrying about the investment account.
Yeah,
Investment accounts
it's a
alone.
whole integration of both your financing and your operations and your investing.
And just for my own purposes, I mean, I have the ability, because I'm responsible for the debt, I'm responsible for the investment accounts. They drag me into all kinds of other projects as well. So I have the ability to speak to this in ways that maybe other peers may not have the ability to do. So I've been able to kind of create this environment in a different way.
Yeah. So maybe why don't we circle back to the investments and
Sure.
how did that end up shaking out? What does that look like?
Sure. So with these kind of concepts, for the liability views and the risk profiles that we're willing to do, we kind of go down a path here of creating the liability profile or the risk profile that we want for the investment accounts. So we've basically structured in tiers at this point in time. We have a cash tier, which is your working capital bucket. We have that scheduled claims bucket, as well as a contingent claim bucket. And then we have the ability to go into a liquids where we just don't think we're ever going to be ultimately touching that money. And if we fast forward on that kind of thought process, you can see the tiers that we've created in the investment accounts that we've created. We've got the operating cash pool, It kind of gets replenished based off of operating flows. I will say it is definitely stressed right now, right? And so, to be honest, that $321 million that you see targeted here, we don't have it now. And in fact, where we do have, and if you remember back a few slides, I was talking about ways to mitigate some of that liability requirements. We have a lot of credit line availability. And so we've drawn down on credit line availability and allowed portfolios to recover. Because when we lost a lot of money last year based on fixed income environments, we did not want to go and liquidate assets within the intermediate bucket or the long-term bucket. So we drew down on credit lines and we basically arbitraged that until it made sense to pull funds. But we're sitting right now in the cash bucket. We're probably sitting at about maybe $280 million, not our full allotment. And the operating line is supporting that. Now the intermediate bucket, we haven't touched. We haven't touched a penny through the financial crisis. I could have gone to the intermediate bucket, but we chose the credit lines instead. And we basically played arbitrage on that.
When you set up this structure back in 2017 and you carved out that intermediate bucket, did you expect that you might tap it over the next 5 years? Or was it more contingency?
It was more contingency. It is a contingency bucket for things that we think might hit within 2-3 years. If the operating line can support it up from a cash perspective, then we don't need to touch it. We could have touched it this year when the operating line was definitely impacted, and we could have gone and pulled funds down from that bucket. It's a very liquid bucket. But again, I chose to go to credit line instead and just pay the fees that we had already negotiated and then walk away from those as the operating line started to improve. And then the balance of the bucket is, again, going into the long-term pools. The endowment sits in that bucket, but then there's a lot of unrestricted assets in there that are included in the days cash on hand count. And we structured the portfolio that is basically 20% preservation and about 80% growth. Overall, overarching all that is that requirement set for volatility levels. There's virtually no volatility allowed in the operating cash position. It's about a 5% volatility count on the intermediate bucket. And then the long-term pool has the bigger volatility targets in there. But overall, about 9.6 volatility target from a blended perspective. And that's how we manage money. We've never had to move any money from the long-term pool to the intermediate bucket. We've moved money into the long-term pool.
Right.
And we've become more liquid in the long-term pool over time.
And so what does that look like then? If we look at the actual asset allocation?
Yeah, so here's a snapshot of that allocation. And again, this was work that was relatively currently done. You can see the three different working capital pool, intermediate pool, and long-term pool, working capital pool. But again, it's short instruments. It's actually an extended working bucket. It actually has a duration of about 1.5 years on it. Liquidity is maintained, and it's basically our sweep account, but it's a dynamically managed account. It's not in a bank sweep vehicle that's earning nothing. The intermediate bucket's about 35, about what am I saying? About 70% fixed income at this point with risk assets and U.S. equity and global equity and international equity. Again, there was volatility in that number greater than the 5% during the period, but that has settled way down. And then the long-term pool looks like a relatively calm endowment from a standpoint of it doesn't have the same level of illiquidity in it. This year we chose to increase the private equity allocation.
Right.
So we've gone from a 12% target to a 20% target. It's going to take us.
And you're legging up to that.
We're legging up to it. It takes time to build up to the 20%, actually cash out the door. And then also for a few years now, we've also been including private debt into the equation as a separate asset class. It's actually cannibalizing assets from core fixed income. Again, stepping into it, we have a target to increase it to 5%. But when you go across the page, you can see the overall consolidated allocations And that's kind of the bands that we live within. And then again, the volatility targets and everything are the ones that we kind of live, that's our guiding stars, so to speak, for the overall portfolio.
And you look at the volatility of the total holistic.
We look
all
at
three
each, we
pools,
look at each pool
one.
individually, because if one gets out of sync, then
And
it's
it's
going to
gonna
throw
throw
the whole
everything
thing
else.
off. So we look at each one and then the consolidated, and these are the numbers that we report out to the investment committee on a quarterly basis, and also up to the finance committee.
Yeah. Now, capital market expectations have changed dramatically this year with the increase in interest rates last year. So are you thinking about anything differently?
So we will go and do a refresh coming up in the summer. We always let the fiscal year kind of exhaust itself, and then we have better transparency to what the operating budget's going to be. We have a new 5-year forecast. We have all the building blocks to kind of then look at it and say, okay, we need to build more liquidity on the short end of the curve here, or we don't need to do that. So all that'll take place. This will be more of a soft refresh than a hard refresh, but we do that every year in July.
Yeah. Now, do you feel, I know when we talk to many of our clients, they view the balance sheet assets, some view it more as a sort of a resiliency sort of component for the balance sheet. Others are looking for long-term growth. There isn't a right or a wrong answer to that. It's individual to every organization. Do you feel like this structure sort of allows you to have a bit of both, where you have resiliency, but where you need to, you can actually shoot for some growth?
Yeah, and that's the, to me, that's the beauty of setting this portfolio up. It gives you the ability to sleep a little bit at night. But when there is opportunity, like we said, we're looking to move assets into that longer term pool. May not this year, but then we did before. We'll probably do it again. And then again, increasing that illiquidity to try to get to the return profiles that we'd like to achieve down the line. But we're never going to be, like a true endowment, because we've got too much demands on the operating line. And we have to keep those days cash on hand targets. We have to keep all those things in line relative to the debt. So it's a very much a balancing act. The rating agencies love this, by the way.
That's what I was going to ask, because I know, in talking to many of our clients, that particularly those that haven't thought about going into private assets yet, and they would like to take on some illiquidity. The first big question is, what is the rating agency going to think about this? Yeah,
when we first started setting this up, and I walked them through it, you could see light bulbs going off the analysts' heads. And we go through this constant, review every year with them, and they always ask, how's this process going for you guys? And we articulate it, and they typically make comments in our reviews relative to the investment portfolios as a prudent approach to managing these assets. So, I think just in a general theme, this has been good for communication with the board, and communication to external parties relative to bank credit or the capital markets credit that we have. We have about $3.4 billion of debt on the street. And so it is something that even the analysts who from your firm or anybody else who's looking to buy our bonds, this comes up.
It does.
How are you managing assets? Because so much of it is tied to that days cash on hand issue that they're focused on.
It is. And I think, over the last if you go back, the last 20 years where we've been in an environment with declining interest rates, it was a much more comfortable position to be in, where you can issue debt at a low rate and know that I can invest somewhat with a moderate risk asset allocation, comfortably get that rate of return that I know is going to deliver a cost of capital plus to cushion, and things will balance out nicely. But that environment has now changed.
Very different.
Yeah.
I mean, even for some of the capital programs that we were looking at, do we build a new research building? Well, when you're looking at rates in the high fives, makes the math equation a little
Mhm.
difficult. And so that's when you start deferring on some of those projects to make sure that you're not getting ahead of your skis on various issues.
Now,
Yeah.
have you had conversations with other CIOs or peers on this? Are you seeing others start to think about this, adopt it?
I always talk about
Yes.
it. So I sit on a fair amount of advisory boards, and it's made up of other CIOs, and I talk about this approach. And I think in the earlier years, I think there was less interest in it. And again, part of in some cases, you have an investment office and you have the finance function, and they're not connected in any real way. And so the investment office has a very different mandate. It's very growthy. And if it's an organization that is more endowment minded, if it's a university or whatever, that's more endowment, this doesn't ring a bell to them, especially on the investment side. But institutions that are healthcare organizations who go through what we've been going through for a series of years, the operating line has become much more a critical issue.
Mhm.
And therefore the demands on the investment side have become more prevalent.
Right.
And so I think this structure now, when I talk about it, it starts, you see other people starting to say,
Start to,
this may be something that we should be thinking about.
Yeah.
They may not execute on it, but at least they'll think about it, which is just what I want people to do
Yeah.
at this point in
we
time.
need to figure out what's the right structure,
Right.
really just take it up to the organizational level and start thinking about some enterprise risk planning.
Right.
Mhm. Now, when you look at the investor structure, were there some things that made it much easier to implement? So you have any recommendations for the audience on things to be aware of, that if you're going to do this, here's what you need to think about in terms of how you set stuff up?
Yeah, I mean, again, as you can see from the investment allocation, we pretty much take advantage of almost every asset strategy in the mix at this point in time. So the concept is how to create, I'll call it synergy between the
Mhm.
investment accounts, so that you can easily deploy monies. There's a gentleman here who works at Russell, Mike Auger. I'll have him. I'll claim he's my partner in what we actually set up. But we had to think about how best to deploy these assets. Once I convinced the investment committees that they needed to kind of work together on this matter, we thought the way we were doing. We always had separate buckets of money. We had 25 different investment managers in the portfolio. Probably when we started this program, I inherited all these mutual funds, all this stuff that was coming into the mix, and I had to figure out how can I redo what I'm currently doing. So the concept that was put on the table was, by creating these buckets of money, is there an opportunity to utilize commingled fund product, so to speak, to be able to distribute across the different buckets, and take advantage of fee scale from managers, as well as administrative fees, consulting fees, et cetera. And so we ended up working with the Russell organization in creating investment sleeves, pools of assets that are the managers are identified by ourselves and our consultants, as well as incorporating some thought coming in from the Russell investment team, to create buckets of assets for the universe of managers on the screen here. I don't know if it's up still, but U.S. equity, non-U.S. equity, global private equity, real asset funds, core fixed income funds, and I'm trying to, in the return-seeking fixed income funds. They're all funds that we're able to deploy across intermediate pool, long-term pool, and then we have mirror product on the DB plans that were set up. That allowed us then to also, in part of the bargaining chip here, I wanted to take advantage of your negotiating power for fees. And so the managers that we picked, in some cases, are managers that Russell has a broader relationship with. And so we structured a transaction that basically said, I'd like to participate at your fee level, and I'll pay you something above that. And as a result of that, we were able to create dynamic pools that are deployed across the spectrum that take advantage of managers that we were going to hire anyway, because of the consulting arm that we use, but at fee levels that were markedly lower than what we have. And in some cases, I will never name names, but fixed income manager that I would have paid 34 basis points has a base fee within a program here that is down in the single digits, and I pay up, a few basis points more for all the administrative work that Russell is doing on this program. And so again, our fees here are off baseline, $8 million less a year from a fee perspective.
Mhm.
And then a dynamic portfolio that allows me to move assets within the buckets without having to go and
Talk to a
figure out how
manager.
I'm going to be liquidating the assets from a whole bunch of different managers.
Mhm.
And then also being able to replicate that on the defined benefit side, and just make it so much easier.
Yeah,
to
and
live
it's
with.
a structure where that allows you to have an individual sort of separate account manager for each asset class, but with the economies of scale and the administrative ease of a commingled product.
Correct.
Yeah.
So that it has worked really well for us over the years. And, as we've diversified the portfolio, it's very easy to add a new site. And so it's a very efficient way to deploy assets, much more efficient than what I was doing in the past.
Previously. So I know I see we're getting some questions in from the audience,
sure.
so let's turn to them. So the first one, it says, how agile is your portfolio? For example, if the debt ceiling isn't resolved at the federal level and Medicare cannot make payments to health systems, what is your portfolio response? Do you draw on the line of credit or change the asset allocation or something else?
Subject to the depth of the problem, we have $638 million of line of credit available to us
That you could draw
that
on.
we could draw on.
Okay.
We could do that, or we could go to the working capital intermediate pool, get money out of the working capital pool to a greater degree if necessary. Intermediate bucket could be liquidated probably T+3 at the most. And there's plenty of assets within the long-term pool. If we had to go and liquidate, that's probably a T+3 count as well. So we have the ability to react very quickly because of the structure that we set up.
So you're not staying awake at night over the debt ceiling.
Well, I am
for
saying,
this issue,
yeah, we're all nervous about it because what happens if they stop sending money from
Yes.
Medicare and everything else, right? I mean, that's a whole operating dilemma.
Issue.
But again, we're not that illiquid even in the long-term pool. We've got
That you
a
can
lot of
invest.
liquidity if we had to go to that bucket. But
Right.
part of the reason we built up our credit line requirements during COVID because we just didn't know what was going to happen. And I chose to maintain those lines, just negotiate really, really tightly on the unused phase.
Okay.
Important.
All right.
Good question.
The next question is, are you moving money between pools more or less often during the current rate environment?
We're moving monies less often, not because of the rate environment that much, but because of the demands on the working capital pool.
Okay.
Rate environment actually presents, some good opportunities to earn more. But on the fixed income side, but right now we're not really doing that because we're supporting the operating line.
Okay. All right. So the next question, you mentioned that you started with a high number of investment committees. Are those committee members still engaged? And how are they feeling about this, how this approach is working? And then how about the board members?
Yeah. All those investment committee members are no longer on any of the committees. When we consolidated all the assets, I worked with the board at that point in time to say, as those individuals were rolling off, I wanted to just populate the board, the investment committee with investment professionals. So the legacy high net worth individual that was typically on our boards is no longer party to this. And it creates a very different dynamic for dialogue when you have investment professionals that you can go back and forth with. So they're all new members. The board, not only the investment committee members who are on this thing, which are made up of CIOs from other organizations, as well as just investment manager types, they love the structure, in all honesty, because it is something that they feel that we're creating an environment where we can grow assets, but also protect the organization. So they are very comfortable with this approach. And the overall board also was educated through the years on the risk profile approach, and they draw a lot of comfort in the fact that we've got, especially now, I just was at a finance committee, and they were looking at operating losses that we have. Members who were party to it back then understand what's set up I kind of educate every year on this. They draw comfort on the structure as a result.
Now, was there a lot of change on your board as you went through the M&A activity, or is that, so there was a lot of change?
Yeah, I mean, the actual board had grown to about 45 members through the M&A, because one of the currencies during the mergers was that they would take in key board members from those organizations. They've since rolled off. The board is now down to about, I think it's down to 22 individuals now, and it's going to go down to about 15.
So it's much more manageable.
It's much more manageable, and they are more engaged. They're more engaged on bigger picture issues than they are on minutia issues, where before it used to get down in the weeds too much.
Okay. So let's see what else we have coming in here. You're working with Russell Investments and others, but what does your in-house team look like, and what kind of in-house resources do you need to make an approach like this work?
I have a very small shop inside. I would say it's 3 key individuals overseeing all the assets of the university. And I've attempted over the years and eventually just gave up, in all honesty, trying to build out a larger office. So the structure that we were describing from the investment portfolio side is what I've done pretty much, not only with Russell, but with other significant investment management firms, is really to create a concept of an extension of staff. And so the program that we have built with you, I mean, I view the Russell people as working for me. So the investment management team, the lawyers, whoever I'm dealing with is really an extension of my resources. We have created on the private side with other providers, we've created SMAs for strategies that we wanted to do. And again, those people I view as working for me as well. So it's really, how do I build a staff without overtly paying for it? That's how I've done it, through creative structure.
Right, and that's the value add, I think, of the relationship.
Yep.
So I've got one more coming in here. If you were to give advice to a peer on how to move to this approach, based on your experience, what is the biggest hurdle you would warn them to watch out for? And what is the big thing that could go wrong? Great question.
Biggest hurdle, I think the logic of the approach works. It takes some education, again, because if you have an entrenched investment committee, or even management above, it's hard for them to get their heads around the concept of these various pools, and why would you have an intermediate bucket? Logically, to me, it's there to offlay for some of these risks. I'm still earning a return profile on this that I'm satisfied with, and that, I think, it was the biggest hurdle. What's the need for that bucket? Again, I've never touched that bucket,
right.
But I might be touching it this year, where I wouldn't have thought about that I was really going to go there. It has also allowed us, we've also talked about scaling down on the intermediate bucket. Maybe in a normalized environment, we might do that, since we've never really touched it. And if I touch it, I'll change my mind on it. But if we don't touch it again in this environment, I may scale it down and move assets more into the long-term pool.
Mhm.
That'll be an exercise that will have to go, that will go through. The biggest hurdle, the biggest challenge was in educating internally why this was a prudent thing to do.
Mhm.
That was the biggest hurdle. And then you always have the hurdles that you're going through about including, liquid assets into the portfolio if you don't have them and those kinds of things. I was lucky that when we started out this equation in our allocation, we were actually at 30%. The goal here is to get back to the 30%.
To 30%.
Yeah. But it'll take time
Mhm.
to get there.
Is there an increase in days cash on hand that you're hoping to get to with the structure?
It won't affect days cash on hand.
Okay.
The other side of the days cash on hand equation is the capital
Is
program. And so the hurdles are set to maintain that days cash on hand. And when we do our capital programming, we go through what we call a constraint exercise, which is also, I will say, I'll give credit to Kaufman Hall on, because it's a model that they kind of pitched through to us. That it defines based on what we think our operating line is going to be next year, subject to potential debt issuance or other factors. It defines how much money we can spend every year on capital. And that again is dynamically linked to liquidity targets and to today's cash on hand targets. So this program, the capital program, all are guided by, how we want to look up to the outside. So it's all linked together.
Excellent. Well, I think we are running near the end of time. We've addressed all the questions. If there is anything else, we can reach out to you. Al, I wanted to thank you. I know you're very busy, so thank you for taking time out to come talk to us. Thank you all for joining us. This is really the first in what we hope to be a series of webinars focused specifically on healthcare systems. We know there is a lot going on. There's a lot of volatility, certainly a lot of challenges. We'll be reaching out to participants that joined us today to get your feedback on this, and also to get any ideas that you'd have or any questions you had for topics that you'd really like some help with or would like us to address. So,
And Lisa, I'll just say, if anybody ever wants to reach out,
fantastic.
feel free to reach out to me, and
Excellent.
I'm happy to answer any questions they may have.
Thank you all, and thank you for joining us, and have a great afternoon.